Research at Citi Markets Edition.
Welcome to Research at Citi Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk, Citi's Global Head of Macro, and with me today is Alex Saunders, our Head of Quant Macro. Welcome to the show, Alex.
Thanks, Dirk.
We're recording this podcast at 9 a.m. on Monday, September 22nd, 2025. Last week, the Fed has started a new easing cycle in reaction to weakness in the labor market. We will go into some detail discussing what that means for US assets and for the US economic outlook before we digress to China. Now, let me start with the obvious, meaning it's a very different asset reaction whether we talk about the Fed cutting into a soft landing or cutting into a hard landing. At this stage, it looks very much like a soft landing to us. And there, the lesson is that equities like it and tend to move higher. Bonds find it difficult, and what the dollar does is actually somewhat unclear. Now, for equities, we made the case only 2 weeks ago that equities do enjoy the Fed cutting into a soft landing. But interestingly, the cuts into soft landing do not necessarily change leadership among equities. Winners keep winning. The market cap weighted S&P keeps beating the equal weighted S&P. And so we keep favoring the US market. Now for bonds, it's more of a headwind. The typical soft landing reaction function by the Fed is really just 3 cuts, ranging from a total of 75 to 100 basis points in easing. If you actually try to forecast before the first cut or at the time of the first cut, how much or how big the cycle will be, the S&P is one of your better indicators. So if the S&P is strong, the Fed ends up cutting much less. So at this stage, that would be in line with just 3 or 4 cuts. Now we price 4.5, and Citi is sitting at 4. So therefore, we see the Fed ease into soft landing as a bit of a headwind. Now 2024 illustrates that. 2024 was a case where the market was pricing aggressive cuts into soft landing, and fixed income pulled back quite aggressively.
So, Dirk, when we study these past interest rate cycles, there's always pushback that, yeah, but this time is different. This is not always the case, but we have changes in the configuration of the FOMC board, a retiring chair, and there's market worries about Fed independence. So, Dirk, is this cycle different?
As you know, probably the most dangerous words in financial markets commentary, but I would say we try to study that. And so if you regress essentially the short end of the curve on a measure of inflation, meaning break-evens, and a measure of growth expectations, and we took the S&P for that, then you come to the conclusion that the market is pricing maybe 50 basis points more than it typically would. So you do have the market pricing a bit more, probably because of these Fed independence worries. But I would have 2 counterpoints. One is really that some of these cuts are priced before May, meaning before Powell is bowing out as a chair. And secondly, I think the meeting that we just had on the margin probably reduces the worries about Fed independence, because you saw Governor Waller and Bowman voting for 25 basis points. So this illustrates, I think, that the FOMC will likely retain a bit of an independent streak. So overall, Fed independence worries will not necessarily stop a bit of a rate sell-off. In the end, it will all be about the labor market. We do need better labor market data before rates can pull back more meaningfully. But Alex, talking about that issue, how do you see the outlook both for the US economy in general and for the labor market in particular?
Yeah, thanks, Dirk. So in the very big macro picture, we characterize the market this year as oscillating between cyclical fears around the labor market and a potential productivity-driven secular Goldilocks theme. The cyclical fears, as we mentioned, are really driven by that fragile US labor market. So we have weakness in hiring, there's been a decline, and there's been negative revisions to payrolls, and we have a fading housing market. So lower rates will improve the housing sector, and our economists are calling for slower growth, but not an outright recession. On the plus side, tariff effects are yet to show. This is not to be complacent. We've effectively had 2 rounds of front loading, pre-announcement, and then after the pause. But we also have an AI-led CapEx boom. Again, going back to how we sort of characterize or quantify the macro environment, growth at the margin a little bit disappointing, but resilient in the face of shocks. Inflation higher than target, but the dynamics do not show a clear re-acceleration. And central banks, as you mentioned, are easing policy, not just the Fed. Financial conditions are loose. This is not a bad place for markets to be in, and we've recommended taking equity risk since April this year.
Now, if the labor market deteriorates more drastically, though, and for how long can equities go up, ignoring rising unemployment?
Yeah, so if those cyclical fears realize, then obviously we expect some turbulence. I mean, that will depend on the severity of the job market weakness. There's a few points to make. The first one, productivity is a good thing for markets. We've seen some evidence of earnings or revenue per employee rising. So this can support equities even with high valuations. And we've also seen jobless recoveries in the past, the early 90s being a prime example. And for all the attention, it's important to bear in mind that the labour market is traditionally a lagging indicator, and as we've recently observed, is subject to quite meaningful revisions. So we would therefore also be paying close attention to financial conditions, and in particular, credit spreads and the availability of credit. So these are very loose and have been supporting markets, but a meaningful and sustained rise could give rise to an increase in broader cyclical fears. But I would say our main message there is to stay the course with equities, and with credit being a potential hedge for any increases in those cyclical fears and volatility.
Thanks, Alex. So far, we covered mostly the US, but there are, of course, interesting topics outside of the US as well. In particular, Asian equities have been very strong. That's partly the AI trade as well, be it in Taiwan or in some segments of the Chinese market. But the general view is that Chinese tech is more competitive vis-a-vis the US than was earlier believed. Valuations are also more benign relative to the US in particular, and China tends to outperform after the first Fed cut in the cycle. Our back tests also show that the earnings revisions index at current levels is quite bullish, and there's some signs that households' deposits are flowing into equities in China. So it's another good candidate to add risk. But of course, September seasonals are usually not great, and we are not done yet. So how do you see that, Alex?
Yeah, seasonals are not the sort of single most important issue, but this time they've coincided with an increase in T-bill issuance, and we find that can drain financial market liquidity. And we have seen some volatility in those front-end spreads, particularly around tax payments that we had last Monday. That seems to have subsided for now. But having said that, negative seasonals are not quite over yet. We have one more week to go, the week of the recording of this podcast. But when we look at those September seasonals, those negative September seasonals, the equity weakness is not super specific. On a vol-adjusted basis, markets in Europe can sell off just as much as the high volatility sort of tech-related names. It's therefore possible to hedge some of that seasonal risk with, for example, European indices.
Thank you, Alex. So overall, the Fed cutting into soft landing is actually positive, but for rates, it quickly becomes a headwind. The US economic outlook is relatively benign, with a recession unlikely in spite of the weak labor market. And outside of the US, Chinese equities still screen attractive. Thank you for joining us today. This episode was recorded on September 22nd, 2025, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on the Citi Velocity portal. If you enjoyed the podcast, please leave us a review on your favorite podcast platform. Next week's Research at Citi Markets Edition will be hosted by Scott Cronert, Citi's head of US equity strategy. Also, look out for other Research at Citi podcasts, which you can access on the same channel. The macro strategy team will be back in 2 weeks' time. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.